On this one, I'm going to walk through short exercise 6-12 in case you want assistance with that one. In exercise 6-12, we have a company that gives us some information about net sales, cost of goods sold, and ending inventory. So those numbers are all given to us. Suppose the company later learns that their ending inventory had been overstated by 13 million. So that 480 million you see there would have been 13 million too high. And it's asking us for what the correct amounts for net sales are, ending inventory, cost of goods sold, and gross profit. How I would do this one is, first of all, the big key fact here is ending inventory was overstated by 13 million. So year one, whenever we calculate gross profit, we have sales minus cost of goods sold equals gross profit. Okay, so we know that. But this is also asking us for the impact on ending inventory. So in the box in the lower right-hand corner, it's a red box outlined in red. I have beginning inventory plus purchases minus ending inventory gives us cost of goods sold. So I'm trying to give you the formulas right there for answering these questions. And again, the key fact is ending inventory was overstated by 13 million. So now we're going to tackle the questions. So the first question is, what are the correct amounts for net sales? Well, net sales is not impacted by ending inventory. Look at that. Sales does not get impacted by ending inventory, so we would say that net sales is unchanged, okay, by an ending inventory error. But let's go on to B now. B, ending inventory. Well, ending inventory is affected by being overstated. Ending inventory, they tell us it's overstated by 13 million. So that means it's too high. Ending inventory is too high. So we would take the ending inventory figure 480, subtract the overstatement of 13 million, and we get the correct amount of 467. Okay, so let's go forward. Now we're looking at cost of goods sold. Cost of goods sold is calculated by taking beginning inventory plus purchases minus ending inventory. Ending inventory is 13 million too high, so that means we subtracted 13 million too much. So what we need to do is we need to add 13 million back into cost of goods sold. So we take the 1,160,000 that's given to us in the problem and add back the overstatement of 13 million, and we get the correct amount of 1,173,000. Now on to D. D says, what's the impact on profit? Well, we look at gross profit, that's sales minus cost of goods sold equals gross profit. We said that beginning inventory plus purchases minus ending inventory is cost of goods sold. Ending inventory is 13 million too high. That means if ending inventory, if we subtracted out 13 million too much, then the cost of goods sold will be 13 million too low. Too low. Okay, and if it's too low, we need to subtract out the replacement cost of goods sold. The easiest way to do this one is take our net sales at 2,500, subtract out that new cost of goods sold, and the new cost of goods sold is 13 million higher. So the 2,500 is the sales given to us minus the adjusted cost of goods sold, which we just calculated, gives us the correct amount of gross profit, 1,327,000. That's it.